So good evening once again. Today objective is listening, and yesterday we also discussed about listening. And for little discussion that we had under listening, I believe that we have gained a lot from it. And today we are going to look at the one of examples that we can see under listening and how we are going to tackle them. So who can help us to read this through, and let's see what we can actually do about it.
Can I go ahead?
Go ahead, please.
A company has decided to install milling machine. The machine cost 20,000 naira, and it was estimated that it would have a useful life of 5 years with a trade-in value of 4,000 naira at the end of the 5th year. Additional cash profit from the machine would be 8,000 naira per annum for 5 years. A decision is now to be taken on the method of financing the project. 3 methods of finance are
being
being
considered.
considered. Yes. A. Purchase the machine for cash, utilizing bank loan facilities on which the current rate is 14% before tax. B. Lease the machine under an agreement which would entail payment of 4 naira 80 kobo at the end of it.
4,800.
At the end of each year for the 5 years. C. Purchase the machine under hire purchase agreement. This would require initial deposit of
Deposit.
if we require an initial deposit of 6,500 and payment of 4,400 per annum. At the end of each of the next 5 years, the interest part of the payment for tax purposes would be 2,100 of the year 4 and
2,100 at the end of year 1.
2,100 at the
end of year 1.
end of year 1.
And
1,800
naira,
1,400, 1,700
naira
at the end of year 2, 3, 4. And the company
2, 3, 4, and 5 respectively.
2, 3, 4, and 5
respectively.
Sorry.
The company weighted average cost of capital is 12%. Full stop. The corporate tax is 35%. Full stop. If the machine is purchased, the company will be able to claim
a written down
written down allowance of 25% of the reducing balance per annum.
You are required
to advise the management whether to purchase or acquire the machine. 2, you advise them on the most economic method of finance. 3, advise them on any other matter should be considered before finally deciding which method of finance should be adopted. So if you look at, hello, are we there?
Yes.
If you look
Yes.
at this question very well, you discover that a lot of information is there which we need to understand each line. So by understanding each line, you need to go back and be picking it one after the other. When the examiner is telling you that the company has decided to install a new milling machine, and they say this machine will definitely cost, so this is how you'll be taking it so that you understand it. This machine will definitely cost 20,000 naira. This is the cost of the machine that they want to install. And it was estimated that it will have a useful life of what? 5 years. 5 years. So obviously, we can see the cost, and we also have the 5 years, which is 5 years. With a trade-in value of what? 4,000 naira at the end of the 5 years, at the end of the 5 years. So, what I will tell you is this. Under leasing, we have two methods to solve leasing. We have traditional approach, and we also have modern approach. We have traditional approach, we also have what? Modern approach. So either of the two methods can be used. Then let's look at the traditional approach. Then we now look at the first requirement that says whether to what? Whether to acquire the machine, which is question A. Whether to acquire the machine. Whether to acquire the machine, which is number one. Whether to acquire the machine. Not only that, let us now, after analyze, I will analyze everything so that you now see. Okay, let's continue from where we stop. An additional cash profit from the machine. They say cash profit from the machine would be what? 8,000 naira per annum for 5 years. It means that cash profit for year one will be 8,000 naira. For year two, 8 up to year 5. Hello, are we there? Hello.
Yes.
Okay. A decision has now been taken on the method of the financing the project. 3 methods of financing have been considered. So this is what the management consider. 3 methods has been considered. So 1, purchase the machine for cash. So they were thinking of the machine that they want to install, whether to purchase it for cash, and they are going to utilize the bank loan facility. That is, they will take loan from bank, and they are paying 14% interest before tax. That is, that 14% will be what? Before the tax. They are paying it based on the money they borrowed. So that's the first thing that they are trying to decide. You understand? They are trying to decide about this method of financing. So number one, financing, they are thinking of, oh, can we take loan from the bank so that we can use the money to buy the assets? That's number one. Number two method of financing is that they was thinking of, should we lease the machine under an agreement, which will entail payment of what? 4,800 at the end of each year for the next 5 years. That is, at the end of year one, they will pay 4,800. At the end of year two, they will pay 4,800. At the end of year three, they will pay 4,800 up to year 5. So they was thinking of, oh, can we lease this? Okay. The third method of financing is that they was thinking whether to buy it, but if they want to buy it, it will be what? Under hire purchase agreement. whereby they have to make initial deposit of 6,500 and okay 6,500 and payment of what 4,400 per annum at the end of each year. That is after you make initial deposit of what 65. So at the end of each year now you now be paying 4,500 up to 5 years. Is it clear?
Yes.
Hello, are we getting this?
Yes.
Okay, so this is everything about the what the method of financing. Number one method is that they are thinking of buy the asset cash, but where the company will get the money from, they will get the money through what? Through bank loan.
Bank loan.
Two, they was thinking of whether to lease the asset and they will be paying 4,800 every at the end of each year. At the end of each year.
Okay.
The third method of financing is that they was thinking to buy the asset through hire purchase. Through hire purchase, that is, they will be
Okay.
paying the money small small, but there must be initial deposit of what 6,500 and
65.
subsequent payment 6,500 and subsequent payment
4,400.
is 4,400. So and a lot of information were given to us. So let's proceed and let's see how we are going to tackle this. If time permit us, we are going to look at the two approach. So
They're coming to speak now.
solution. So using traditional approach. So if by time permit us, we are going to use the two approach. Use traditional method. Use traditional approach. Then A is talking about whether decision or what acquisition, whether to acquire the machine. So decision on acquisition, decision on acquisition, whether to acquire it. So and what we are going to do is that we now compute, you say computation of net present value, net present value. So if the machine that we want to install, let's assume it's just like a project. If it is viable, that is, if it is giving us the positive MPV, then our decision on the advice to the management is to acquire the machine. You understand? So we just advise them to acquire the machine since the installation of that machine, it is viable, that is, it's giving a what? A positive MPV. But if it is giving a negative MPV, then we cannot advise them to acquire the machine. Hope is cleared.
Okay. Yes.
Okay, so year 1 to 5, but because of there is initial outlay, we have year 0, year 1, year 2, year 3, year 4, year 5. Then, are we following, please?
Yes.
Okay. the cash flow we have 20,000, which is the initial outlay of that money, the money that we want to use for the machine, the cost of the machine. Is it clear? Hello?
Yes, we are here.
20,000. Yes, it's okay.
20,000.
It's clear.
We have cash profit. So we are told that there is a cash what? Cash profit. So how much is the cash profit? They are telling us
8,000.
8,000 naira per annum for 5 years.
8,000 naira.
So, okay, for 5 years. It means that 8,000 for year 1, 8,000 for year 2, 8,000 for year 3, 8,000 for year 4, 8,000 for year 5. Is it clear?
Yes.
If it's not clear, let me know. Okay. What again? After that, what information we underline again?
Trading value.
And it was, who is that person? That person should move, please. And it was estimated that it will have a useful life of 5 years, and with a trade-in value of what? 4,000 at the end of 5th year.
Or 4,000
So at the end of 5th year,
of 5th year.
so at the end of 5th year, there is a trade-in value of what? Of 4,000. So you put the 4,000. So at the end of 5th year, a 5th year.
No, it's 4th year you put it in.
At the end of 5th year, there will be trading value of what? 4,000.
No.
So then, because there is a cash profit, listen very well so that you will not be cramming anything. No. Because there is a cash profit, and since there is a cash profit, you have to look for tax on cash profit. Tax on what? Cash profit.
Okay. Cash profit.
And what percentage of tax that was given to you? They said corporate tax 35%. So then 35% of 8,000, what do you have?
Economy.
280.
2,800.
2,800.
Hello?
2,800.
What is that? 35%. I need 35%.
Of 8,000.
Yes.
That is 2,800.
2,800.
2,800. Okay. So now, what actually happened now is that what's it called? When there is a tax. Hello. Hello. When there is a tax on profit, it means that the tax that need to happen in year 1, when are you going to pay it? tax of year one, when I say
Year
it
two.
begins in year two, yes, because the tax on year one will be paid in year two. That means if the tax, because they are silent, obviously it stands, what is it called? Obviously it stands in what? In arrears. Hope is cleared.
Yes.
Yes, it's clear.
Okay.
So year
Now,
two will now be 2/8.
no. I'm not talking about value now. Just understand it. The tax that you
Okay,
are
okay.
putting for year two will be paid in year three. Is it clear? So the tax you
Yes.
are computing in what's it called?
Year three
In year three will be paid in
will be paying year four.
Year four.
year four. Okay. I believe that you are getting this.
Mm,
So let's move to what other information is there
okay.
before we go
Except,
ahead.
okay. The company
Okay.
work is 12%.
No, yes, yeah, we are going to consider that, no issue. They said the interest part of the payment for tax purpose will be 2001. The interest part will be what? 2100. Hello.
Right.
Okay.
They said 2000 what?
2-1.
2001.
100 at the end of the year one.
I believe that you understand everything that we are doing here. If you don't get it,
Yes.
just let me know so that what's it called? So that we can see how we are going to lay emphasis on it again. Are you with me?
Yes.
Hello. So now let's
Yes,
now
we are
go.
here.
Okay, let's now move to what's it called? The tax that we want to compute now. You know, we want to take 35%, that is tax on the cash profit, right?
Yeah.
And before we consider that, let's do something. Hello.
Hi, you are with you. Go ahead.
Okay, I believe that we are getting it. The one that we just did, I believe that we are getting it. Now,
Yes.
if you look at all the
Yes, we
information,
are putting it.
that's what I said. You need to be very careful and pick, hello, and understand any other things again. We are okay. We have 35%, right, as the corporate tax, and also we have a written down allowance of what? 25%. So meaning this written down allowance, obviously it is called capital allowance. Let me explain something to you. What is the meaning of capital allowance? Capital allowance is allowable deduction in lieu of depreciation. So capital allowance is a relief. It means that out of the profit that the company makes, so far the capital allowance is given, we have to relieve them. Whatever change that we now have as the remaining profit will now be subjected to tax. Is that clear? Hello?
It's clear.
Hello?
Okay.
And you
Yeah.
need to be fast. We need to be fast. I think my data will soon round up. This thing is actually chopping data seriously. So it means that out
Write
of this
down.
profit, out of this
It's clear,
profit,
it's clear.
this profit is 8,000 naira, right? But since there is a capital allowance,
Yes.
obviously you cannot charge 35% straight on this because there is a relief, because there is a capital allowance. So since there is a
Okay.
relief, then you have to calculate the capital allowance. You can say working notes so that you get the capital allowance. Working notes. Computation of what? Capital allowance. Capital allowance. Because capital allowance is a relief. So you have to relieve this from that profit. Then the remaining one, you now tax them. So now, the asset that you purchase, that is year one. What is the cost of that asset? Okay, I say year one, year zero, right? The cost of the asset,
20,000.
Yes.
20,000.
20,000.
Then there's what's it called? What's the rate? What's the capital allowance rate?
25%.
25%. So you charge initial allowance at 25% because they said on a straight line. So 25%
Okay.
of 20,000, what do you have?
5,000. 5,000.
5,000. So this 5,000 is your capital allowance. You bring it out here. Then you
Okay.
remove capital allowance from this. It will remain how much?
15,000.
15,000. So this
Remain
15,000
15,000.
is what you are taking to year two. Because this is year one. This is the year one charge. Is it clear?
Yeah.
This is the year one. This one is just cost, but this is the year one capital allowance that you charge. So in year two, you will take initial allowance at what? At 25%. So 25% of 15,000.
3,750.
3,750. So 3,750 is your what? Capital allowance for year two.
Okay.
Who is that person now? So remove this so that you move to year three. When you
11,250.
11,250, the initial allowance at 25% because the second capital allowance 25 on this reducing balance. So that is why they are charging on reducing. That's why they call on a reducing. So 25% of 11,250, what do you have?
2,813. 2,813.
2,813. So this is the capital allowance of year three, 2,813. Then when you reduce it, the balance is what you are taking to year four.
8,437.
Initial allowance at 25%. 8 what?
Wait.
844.
844.
I can-
8,437.
437. So 25% of it. What do you have?
When did you get 2,000?
The first to
2,109.
2,000.
109.
So this is your capital allowance for year
This
4.
is my 15.
Then you do it again. So you are taking it to year 5.
Year 2.
So what's the balance?
6,328.
6,000.
328.
328. So 25% on this.
Coming up.
1,582.
25% of 6,000.
1,582.
1,582.
Now, okay. So what you now consider that I want you to understand here now is that you now check your question that at the end of the year 5, what's happened? Is there a scrap value? Look at it. There's a scrap value. This 4,000 is a scrap value at the end of year 5. That's what the examiner is telling you here, that under the hire purchase agreement, this will require an initial deposit and payment of, okay, not this place. That one is, where is it? Okay, yeah. They said cost, it will cost you 20,000, and it was estimated that it will have a useful life of 5 years. So at the end of that 5 year, they now said with a trade-in value of 4,000. So this is a scrap value. It means that at the end of the year 5, that asset will remain 5,000. So you now come here and say scrap value. Scrap value. Because that's what it will remain. Scrap value of 4,000. So if the asset was remaining 5,000 at the end of year 5, then what is going to be the capital allowance that is remain that you charge from it? So meaning you are not charging what's it called? 25%. Do you get my point now? It means that how much is going to be the capital allowance if the scrap value remains. So just remove 4,000 from this. We have 2,000.
2,328.
2,328. So that's what is going to be your capital allowance. Hope it's clear.
I want to see that year 4, sir. Let me see that year 4.
So there's no time. There's no time. Year 4 is normal thing that you are computing. Whatever you compute in year 1, just follow the series. You follow your series is the same way. Just charge 25% of the whatever that remain, reduce it, and again go again. 25% reduce it, 25% reduce it. Then go again, 25% of this, reduce it. Even though if the value is not correct, then you can use your calculator and check it yourself.
Okay.
So now, what's it called? So we are going to get what's going to be our what we are going to charge now as 35% on what? On cash profits. It's not going to be this one. Do you get my point now? Because of the relief, you now say in year 1 there's a capital allowance of 5,000. Do you get my point? So 5,000 minus 8,000.
3,000.
So it is from the 3,000 you can now charge 35%.
Okay.
1,050 naira.
So 1,050 naira will not be put in here because whatever you tax in year 1 will be paid in year 2. Do you get it now? So it's an outflow. You must understand. You know, I bracket this. The reason why I did not bracket this is an inflow because it's a profit. It's an inflow to the company. So, but the tax, you are the one paying tax, is an outflow. That's why I bracket it. You need to understand that one also. Don't just say that I'm bracketing this, I did not bracket this. Look at this one. I bracket 20,000 because of it is the initial outlay. The cost I used to purchase that, the cost I'm going to use to purchase that asset is an outflow. So if you now remember the 4,000 I put here is an inflow because the scrap value, they call it trade in value, in something that comes in. You get my point now? So you must understand, why are we bracketing this? Why are we not bracketing this? You must understand that one. That's what I say. It's not a matter of cramming. No, you must know the reason why this one is in bracket, why this one is not in what? In bracket. Okay. So we've tasked this now and we pay it here. So the second one, we have to pay it in year 3. So 8,000 minus 3,000. Then you tax, you check, what's it called? You now take 35% of the tax.
1,505. 1,505.
I got 1,482.
Another person should confirm so that I would know which one to pick.
8,000 minus 3,750. 1,488.
Okay, 1,488. Then we move to the third one. Then we pay it in year 4. So let's look at the relief that was there. 2,813 is the relief. So remove it.
1,000.
I believe that we are all following. No?
Okay.
1,000.
Yes.
One word.
1,815.
1,815. Then, so we move to this and we pay it in year 5. So that means we remove the relief of this. We've done this, so we remove the relief here. So what do you have after taking relief? Then you take the tax.
2,062.
2,062. Another person should confirm. This one will be paid in year 6. So that is why you now increase this one to year 6. Do you get my point now? So because the one in year 5 will be paid in year 6. So that's why you have to extend the year to year 6. So that's why you need to understand. Not that you start putting 1 to 6. No. Because there is no logic behind say 1 to 6. Even if I put 1 to 6, obviously I don't know what I'm doing. It will look as if I cram what I want to do. It is year 1 to year 5. But because of the task that you consider, because of the task is that the task of year 5, when are you paying it? You pay it in year 6.
Year 6.
Unless if the examiner is telling you that the tax is paid at the year they occur. You get my point now? If the examiner is not silent about it and is telling you that the tax will be paid at the year they occur, so meaning the tax of year 1 will be paid in year 1. If the examiner is telling you that it will be paid at the time they occur, you must understand it very well. If the examiner is silent, it means that the tax of year 1 will be paid in the following year. The tax of year 2 will be paid following year. But if the examiner don't want to be silent about, the examiner can tell you that so the tax will be paid as they occur. It means that tax of year one will be paid exactly in year one. Then, if it is that case, then this issue of from year one to year six will not be happen. Obviously, will stop in year five because the tax will be paid as before. But this time around, the examiner is silent about the tax, how it's going to be paid. Then it means that the tax of year one will be paid in following year. So what's going to be the one paying year six now?
1,095.
1,985. Hope is cleared.
Yes.
So after that, you can now calculate your net cash flow. Net cash flow means after you consider all the deduction. After you consider all the deduction, that's what I mean by the net cash flow. It's just like when they are telling you that this is your net salary. You know, your net salary is after you consider the payee and all the deduction. So let's see, 20,000, nothing is here. So 20,000, you are still going to have the same 20,000 here.
Okay.
So let's check the year one. What's going to have in year one? Same 8,000.
Okay.
Year two will be what? 8,000 minus
Okay.
1,050.
1,015.
So what do you have? Be fast. You have to be looking at my
6,950.
device.
6,950.
I have just 6,000.
950.
Okay, year three. What do you have in year three? 8,000 minus 148. What?
512.
6512.
Year four.
6185.
6185.
85.
1,000.
5938.
5938. Okay.
1,000.
So nothing is here. So
It's
it is
99. That this one is
5938. 5938.
did you add the 4,000?
you had the 4,000 now. There's money
Oh,
here.
sorry. That is 9938.
998.
9938.
38.
What of this one? So this one will still be in
1985.
bracket. It will still be in bracket too
Yes.
because nothing is here. Yes, now nothing is here. Just like it's very simple. As nothing is here, call it is zero. Is zero plus zero minus 1985. You still have minus 1985. Is it clear?
Yes.
Yeah.
Yes.
Okay. We move to DCF. Discount factor. Discount factor at. So what is the percentage of discount factor? Please give me like 2 minutes. Hold on, please.
Tabaliki.
Ma. Sarah, ma.
Oh, rántí ń kún mi àwọn
So
láti ṣe
class is recording. Don't talk anything. So I'm back. So DCF, what is the DCF given to us? You can see it from the question. Then let's look at it. So what is the WACC given to us? What percentage?
12%.
12%, okay. WACC of where is it? Okay, WACC of 12%. That is a discount factor. That is weighted average cost of capital. So 12%. So the WACC in the discount factor in year one, it is always the discount factor in year zero, it is always 1. Then you just use this formula to tackle it for the rest. 1 plus rate, your rate is 12%. So, but year zero, it is always 1. Even if you calculate it, it is always 1. Year zero, it is always 1. Even if you calculate it, year zero is always 1. But year one, so we just say, let me do this one. 1 plus R. R is 12%.
First year 0.8929. Hello.
If you have stopped presenting now, or is it still
You want
okay?
target.
Hello? Hello?
Yeah.
Hello?
Hello?
Hello? Ṣé ẹ̀ ń gbọ́?
Yes.
Dàpọ̀ ní data ti tán o. Èmi dẹ̀ ń jà láti ṣe ń bi nẹ́tíwọ̀kì mi ò dákọ̀ ọ̀run.
Yeah. Network only.
Nọ́mbà àwọn tó wà lórí kinní yẹn náà ló máa jẹ́.
Báwo network tó jẹ́. Madam Shadia. Hello.
Mo fẹ́ pè kí n béèrè ni màá dá yín lò. Wọ́n ní MTN mà.
MTN.
Bẹ́ẹ̀ni.
Okay. Ṣé MTN ní nọ́mbà wọn? Calling number yẹn àbí? That same number àbí?
Nọ́mbà tó wà lórí WhatsApp yẹn.
Okay. Ẹ fẹ́ kí n wọ bá máa lè ṣe kékeré mi. Madam Shadia,
Ma,
mi ò ní much o, but mo ti ṣe 2.5 gig.
okay. Wọ́n máa connect padà sí ẹ ṣé.
Wọ́n má bínú, kò sí rẹpẹtẹ ńlẹ̀ ni.
Wọ́n máa understand.
So, let's continue. What do you have as your discount factor in year 2? In year 1, rather. In year 1, what's going to be your discount?
8929.
What?
0.8929.
Any approximation?
Yes, I approximated.
0.89.
29.
So that is 0.893. So I say use
No,
3
no.
decimal. Use 3
Okay,
decimal.
okay.
Since I use 3 decimal for the first one.
Okay.
0.893. Fine. So what of the year 2?
0.797.
0.797. What of the year 3? Use the formula, just change that raised to power to raised to power minus 3.
0.712.
712. What of year 4?
I'm coming. 0.636.
0.636. What of year 5?
0.567.
567. What of year 6?
Yeah, I'm coming. 0.507.
So this is your discount factor. Then you now look for present value. Present value. So present value will be your net cash flow multiplied by discount factor, NCF multiplied by discount factor. So 20,000 times 1.
20,000. No.
Madam Shadia,
Ma, wọ́n ní sísẹ́mù tí wọ́n fẹ́ tọ̀ padà
ṣé kíláàsì wà lọ́la máa?
9 o'clock.
Àwọn ọmọ fẹ́ jí látẹ̀kọ̀ wá bẹ́kúta lọ́la wàhálà ti wà.
Ọlọ́run jẹ́ ariwo àlà, ó ti tán.
Ẹni?
Ọlọ́run jẹ́ ariwo àlà, ó ti tán.
Olúwa ṣeun, adúpẹ́. Àti tètè jí ẹ ní 9 o'clock àbí?
Bẹ́ẹ̀ni.
Dr. Nuruddin àbí?
Bẹ́ẹ̀ni.
Láàárọ̀ wa lọ́lọ́run jẹ́ ń bá kíláàsì ẹ̀ ẹ ṣáà kọ gbogbo nǹkan tó ẹ̀kọ́ nóòtì kẹ́ gba area of concentration bẹ́ẹ̀ pé mo gbọ́ pé last class nìyẹn.
Àwọn fún ilé of concentration ẹ̀ máa fi dára yín náà.
Kó ṣàwí kankan ṣe àti wọn pé gbogbo ìwé ẹ̀ la máa ń kà.
Oh, hello.
Yes, sir.
Hi.
So we just multiply your NCF multiply by 1, so it will be 20,000. It's still in bracket because this one is in bracket. So 8,000 multiplied by 0.893. So what do you have?
7144.
7144.
Kí ló fi multiply yẹn?
NCF multiplied by discount factor.
Okay.
So the third one will be what? This times this.
5539. Sorry.
5539. Then the fourth one.
4637.
4637.
0.7.
And the next one.
3934.
3934.
3934.
5635.
5635.
0.6. 36. No.
The next one.
Minus 1006.
100 what?
6.
And 0.6. 36.
100
6.
6. Not total it. So as it appear, you press minus 20,000 because bracket means minus. Minus 20,000 plus this, and then when you get to the last one, you say minus 1006.
Is it minus or plus minus 1006, or I could just say minus 1006.
It is minus, any bracket is minus, just say minus 1006. So whatever you get is your input.
5,883 positive.
5,000.
883.
883.
So since it's a positive answer, then you can now put your decision. So decision is that the company should acquire the assets. Since it gives positive, is the company should acquire
1.507.
acquire the assets. So that asset is machine. The company should acquire the assets. So this is requirement 1 under traditional method. So the requirement 2 under traditional method is that the most economic method of finance, and also the requirement 3 under traditional method is that what's it called? The other matters. So can we still proceed, or we should just call it a day? So when next we discuss about it, then we continue.
Can we finish it? Can we just finish this one? The traditional method.
Traditional method, okay, no problem. So let's move to
Madam Shadia, consider what I'm following.
Ẹ má bínú, opinion ni tó bá ti sọ̀rọ̀.
Okay. Voilà.